why did we see such a strong rally today on news that the government or that the administration was pulling back to 30% tariffs while discussions are going on?
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital.
And
please
we
seek
are
advice from a
back
licensed
with
professional.
another edition of the Daily Dots. And unfortunately, I am not joined by the Brain Trust, Mr. Chase Taylor. He is on an airplane flight coming back from a graduation ceremony. So congratulations to Chase. He'll be back on in the swing of things tomorrow. And you know what? In a way, kind of a good day for him to be gone. Meaning, there's plenty to discuss, obviously. And as far as the markets go, that is, I think markets are making a lot of assumptions. On a fundamental basis, I don't think there's a lot to what's going on here, but some big levels were hit today and crossed in markets. So we'll go down that first and foremost. Where are we at? Okay, so S&P closing number is up 3.26. NASDAQ was up 4.35%. VIX got hammered down about, what was that? Spot VIX was down about 16.5. Gold got smacked around down for 3% on the move. Nasty day for gold, not unexpected because the dollar ripped, which is interesting. Not typically a sign of risk on, right? But dollar ripped and makes sense, right? You get an announcement like this coming off of, what was going on and how hard the dollar got slammed on the way down. Doesn't surprise me at all. Where are we at in rates here? This is one of the things I think the market is conveniently forgetting. Let's see. We've got 10-year was up pretty healthy. You're right, just shy of 4.5. So we're at 4.45 on the 10-year, 4.88 on the 30, up 1.14. That ain't going to help out. That ain't going to help out on the real estate side of things. I can assure you that. But what do we got? So let's get into this. Why did we see such a strong rally today on news that the government or that the administration was pulling back to 30% tariffs while discussions are going on? Okay. So is that a big relief? Sure. First of all, it's a very positive move, right? As far as the trade deal goes. And I think the best thing to look at is I think we need to separate this into two different things. We got to look at this as far as the trade war and what is good for the economy. And then we've got to kind of look at it as the market. And I think there's two different sides to this. On the trade side, despite the fact that we have absolutely zero details, there doesn't seem to be anybody or anything pushing back on the other end of it. You would think that would be the case if the administration was overspeaking or celebrating too soon or something like that on a trade deal. I would expect to hear at least rumors of people pushing back. People, where you get these stories out, right? Those with knowledge of inside details, right? Those with knowledge of the negotiations. Haven't heard any of those. Now, I think that's a big win. Now, what we're all forced to do is we're all forced to speculate, okay? But considering the time in which elapsed, I would think that would probably mean pretty good things as far as the posture of the Chinese as it relates to what they were willing to do, right? It's a sign that good things were brought to the table. And that's going to be really interesting because if that's the case, and again, we're speculating, but if that's the case, I think you've got to assume a couple things. First of all, I think you got to assume that the whole adage of China's fine and this isn't hurting them Now, I thought it was a ridiculous argument from the very beginning because of what we've always talked about, right? If you have a trade war between somebody that's running a surplus and somebody that's running a deficit, it's the deficit country that has the advantage. I think that advantage is a little bit less pronounced in this scenario as it relates to the United States. I don't think that advantage is as big for the United States as it would be in similar situations for a variety of different reasons. But still, that's the case, right? The other case, Trump's going to blow up the economy. I think this is another example of, like I've said from the now, look, we don't have a trade war. We don't have a trade deal yet. Okay, so I would still say right now, this is very premature, right, to say the least. But I definitely a positive, constructive move, you'd have to say, on the trade side of things. Where does this lead us? You know, some people are hearkening back to the last trade deal we had with China, but remember what happened. You eventually got a trade deal done, okay? And I think most importantly, it's important to remember, if you were bearish at that time, it was extraordinarily frustrating because the market really didn't go down when the bad news was coming out, but you rallied every single time when you said there was a trade deal, right? So it was like the lack of a trade deal didn't hurt you, but rumors of a trade deal always drove you up. After watching the action today, I think we have to be very open to that happening. Now, flipping back, is it really so on the economic side, I trade bears, Trump administration bears as it relates to trade wars, people saying the tariffs aren't going to work, it's only going to blow up the economy, China's not going to come our way at all, this is a horrible way, you'll never get a trade deal done. That narrative took a hit today. No question about it. So I think that's a win for the administration. Again, prematurely, we don't know what the details are, but I think it's a win for the administration. More importantly, I think it's a win for the global economy, right? Nobody wanted to see this get out. Now, again, I will enforce and I will reemphasize, we are speculating. Nobody, you guys weren't in any of those meetings. I certainly wasn't into those meetings. We haven't spoken to anybody that's in those meetings. Nobody involved in those meetings has an incentive to say that something didn't go well, right? At the very least, positive things buy them time. So you got to take all this into consideration. I'll still stick to my stance, which is, look, Trump was taking a risk taking this approach, but it's one of those things. If it ends well, then all is well, right? Risk reward, certainly, but definitely I would say at the very least, you got to say that this is constructive, for the global economy, for the markets here in the United States and for our markets. Okay, now let's look at it from a stock market angle. This is precisely what we said we'd see happen, right? Meaning if you got news over the weekend or if you got positive trade deal news at any time, markets would rip. That's what happened, okay? And we said, I don't care what the reality is, markets will rip. That's what they've been trained to do. That's what you saw today. Interesting thing, though. So now, look, markets do not have to do what anybody thinks, including me. But I will say this. This market would feel a lot more sane to me if, going into today, the market was down 10 on the year, and today was like a 4 or 5% rally. That would feel a lot more normal. But you got a market that's trying to push positive in the midst of all this at these elevated prices. And look, I'm not throwing a wet blanket on it. We own U.S. names. We didn't have a great day. We had some positions that were up big, but pretty much our gold. We had a few shorts. We really didn't have a lot of short exposure going into this because we thought this could happen. But gold got hammered today. That wasn't fun. So it wasn't a great, exciting day for us. I think we finished flat on the day. Still, I think up 7 on the year now. But so gave back some of that outperformance. But here's where it's really interesting is, I mean, guys, right now, the good news is 30% tariffs where they didn't used to exist. And we've talked about how frothy markets were and how historically overvalued they are in relationship to other global markets. And I still, Chase has talked about this. I just think that the setup here is just perfect for the ultimate bear trap, somewhere between this level and the highs. Could be wrong. And look, like I've said, I don't think, again, I think what happened today further takes away that uber bear risk. We're going to have a market crash impending. Now, did you have to be concerned about that? Well, yes, I think you have to be concerned about it, especially here in the US. When you look at the levels, like look at the exuberance. You got a market that's trading now 27, 28 times earnings. With 30, like that sounds pretty crazy, right? Considering the trajectory of the underlying economy, not horrible, but slowing. And I think a good example of kind of again, we were saying you would get positive trade construct. If you get positive trade news, market's going to rip, full stop. We said it 100 times. Okay, but here's the problem. When I say problem, again, I'm not pointing to things that are just that I think are just going to open up, or a black hole is going to open up and just swallow them. I'm not looking at things and saying I think you're going to have a massive crash. But here's the problem the U.S. markets are still up against. I think Apple is a perfect example of this once again. Okay, Apple rallied almost 6.5% on today's news. That's a massive rally for a company that size. Okay, even for Apple, that's a big move for Apple. Okay, what changed today? In the fourth quarter of last year, if I'm not mistaken, their sales of iPhones were down 11% year over year before any of this was put in place. Okay, now I look, I do not know exactly how those impact Apple products, but to my understanding, the existing tariffs in there are 30% or matching what ours are, right? It's 30% across the board. Maybe there's a carve out for phones. I don't think there is. Wouldn't make sense if there was. And I haven't had a chance to, right? Usually that's kind of stuff that Chase is reading through while I'm talking to clients and handling other, stuff on it. But think about that. This is a company that isn't growing. People are like, oh, yes, it is. It really isn't. If you go through and look at phone sales, I think you're growing at like 4%. So barely above the inflation rate. And that was 4%. And who knows what the impact is? We're going to see it. But I think that you're going to see another negative quarter in China. Like I said, you had a nasty quarter in China without the tariffs in Q4. That trend seemed to continue in Q1 numbers. But remember, those were offset by front-running tariffs. So when I saw their numbers, especially in China, I was actually expecting to see a surge. Remember, I don't know if you guys remember, but I was saying I actually expected Apple to post a beat because of that. And their numbers were muted even with that front running. And it's at 32 times earnings. Now, look, you've seen stupid valuations for a really long time, so maybe it doesn't matter. And that's possible. Maybe people just keep dumping money in the S&P 500, right? Whenever they do, right? 6.5%, 6.5 cents out of every dollar is getting dumped right into Apple stock, right? So you're playing the passive game. I do not at all think you're out of the woods. And I certainly do not think it's just to infinity and beyond from here. And just to keep everything into perspective, okay? I think the S&P is still slightly, let's check here real quick. You're right at flat on the year. Okay. So, it's no great digs, but nice to get out of that negative territory, right? At one point you're down 16. I want to say it was not, we're down 15, 16. Yeah. So you're down 25, 28 bips on the year. SPY is maybe the index is the actual index proper is slightly different. Well, yeah, you've got internal fees and said that. So you're running flat. Okay. That's a nice comeback, but that still puts them way down, even after today, way down the bottom of the list for the best performing stocks. And I personally just believe that that's not going to change. I will be very surprised if over the rest of this year, this remaining year, international markets don't continue to outperform. I just think that they're so much more coiled. I think you've kind of awoken something like we've talked about. I think that you've had an awareness. I think investors are once again reminded of the benefit of being not all in one country. So again, I wouldn't expect, I don't think you're going to see a giant morass without something crazy happening on the trade side, right? There's always the threats of exogenous shocks. But I also heard somebody, I think I mentioned this before. People were saying, you guys, you freak people out and totally, I got too bearish. You made people look, if you sold out of your stocks based on what we were saying, I'm really apologize to you. We didn't. And we never said to. As a matter of fact, I don't think you're ever going to hear me come on and make recommendations like that. A, because I can't legally. But B, we specifically said, keep what you own, know what you own, but you need to start diversifying because assets are going to flow out of the U.S. And in that process, we also started to discover, and obviously we know that foreign markets are considerably undervalued when it relates to the United States. But it's always kind of one of those things where a situation exists, but then once you actually start getting into it, right, you start doing the work, you start shoveling, and you start realizing, wow, this is even substantially different than I thought it was, right? The value opportunity, because when you look at it on an index level, you'll see, they're trading at 10x earnings. Yes, that looks like a big discount to 27, right? But what you don't see is the companies in there that are growing at double digits and trading at single digit price to earnings ratios with clean balance sheets that benefit great from a falling dollar if we have in fact shifted into a falling dollar regime. That benefit great from cheap oil and cheap commodity prices, which we currently have, and underlying markets that have gone nowhere for a decade and a half. And so again, I think it's one of these times to reacquaint yourself, right? Everybody's portfolio for such a long time. It's how is it done? All you had to look at this is just look at the S&P. And like I've said to you guys, that is the historical anomaly. Not historical. I mean, most people have always been U.S. biased, but it is actually rare to open up a retail portfolio and see any exposure to anything international anymore. And again, I just think you've had several warning shots, several calls, several acknowledgments. And if you're just chasing names, if you're just investing in dog whiff hat, and congratulations, I know Chase had some dog whiff hat, that cryptocurrency, that meme coin that he added to his portfolio in his PA account a little bit ago, and it went on a run. But I mean, if you're chasing that kind of stuff, international markets probably aren't for you, because as long as this environment is still going, you're going to get the volatility and price swings and all that kind of stuff. And if you want crypto exposure, I think it's fine, but I think you need to limit your size. I don't know. This one feels different to me. I just don't think you're going to infinity and beyond off of this, and we'll see. We've joked around and called it a Buzz Lightyear market in the past. And when I've been concerned in the past about the market's ability to make new, this cycle's still going. So I've been wrong before, could certainly be wrong here. The one difference in this one is we've never tried to blast off from this end of the valuation range. Not with, right? There's no, when you look at the economy right now, I don't see any slack that you can really count on to push higher. And the problem is if that force does come, if that economic force to just keep pushing higher from here, it's going to be very hard to see that not engendering, some inflation. So again, could be wrong. If you put a gun to my head and said, Zach, where do you think the market's heading over the next year? Right now, right now, given the setup, I would probably say I think the odds are pretty strong that you're going to end the market. I think you'll end this year lower than current prices. That would be my guess. What I would, like I said, what I will be really shocked though is if we get to the end of the year and regardless what happens, a portfolio that has exposure to some of these commodities like gold and precious metals, even oil and nat gas. You know, if you don't have any oil and stuff in your portfolio, I think this is a great place to start building positions. Oil's bumped up a little bit here, so I wouldn't load up on it. Again, I think the positions, ironically, in right now that we should be the most patient on purchases is probably those energy names, nat gas names, oil names, gold names. Why? Because they've run a lot. And if there is any legs to this kind of euphoric run, and if I'm wrong and you're at new all-time highs here in the next 2 weeks, I would be surprised if those stocks run up with them. And why do I say that? Because remember, this is kind of what everybody's thinking. You don't have an economic setup right now that favors the price of oil. Now, generally speaking, do I think it's good to pick up some of these names that have been rocked through this process? Yes. But remember, like I said, building a position. You still have OPEC out there not cutting back, right? They're not trimming. And again, we've said they're doing that as a favor, in our opinion, to Trump. Okay, Trump hasn't, he still wants to keep oil prices low. Inflation is still a threat, right? And the underlying economic growth is really weak. So I think it's great to start buying here, with leaving room to add at lower prices on the commodity side. But this is where we got to kind of yes, market sentiment has shifted. But we got to sit back and remember the underlying demand situation, and it's not good. Now, can that change? Sure. But it's looking, everything's looking really, really, really stretched here. Certainly on a fundamental valuation basis. So, I think we still, as always, need to see whether these markets start to care, do care, don't care. I'm not really sure. Okay, now, one thing we got to do before we finish up here, the road show, I've got signs all over the thing, Zach. You got to tell people. So next Thursday, May 22, we're doing our road show. It's free of charge for any prospective clients out there, people that want to know what we do. We're active managers. What does that mean? How do you guys run portfolios? What do the results look like? What is your philosophy? What do you guys charge? How do you do it? We go through all that stuff. It's about a 45-minute presentation. You go to bulwarkcapitalmanagement.com, sign up for free. It does not lock you into anything. You don't have to talk to anybody. It's just to get to know you, right? And if you like what you hear, and I hope you do, that's where you schedule a one-on-one consultation with me or one of our advisors, and we run you through the whole thing. And it's really simple, guys. Lay out what you currently have, look at fees, expensive performance, all that kind of stuff. Tell you what we do, how we do it, run a comparison, run you a sample portfolio. There you go. If you want to go forward, you want to become a client, give us a call. If not, we're not going to bug you. Okay. So great way to kick the tires and kind of see if it's fit. So anyway, back to markets. Gold, the move doesn't surprise me. I think I've told you guys a bunch. That's why we lightened up on our gold positions as early as Friday, I believe. Or was it Thursday? Last day they got a good rip. It was either Thursday or Friday. Didn't get rid of all of them. Didn't even get rid of most of them, right? But just took some profits, hoping to buy lower. You just look at the history of gold. It seemed crazy to me. Now, maybe we won't. Maybe we'll arrest here. Because I do not think the impetus to own gold has gone away. I don't think this changes anything. I think this was just that immediate unwind. Gold longs getting less long, right? Because of today, knowing that a situation like that, you'd probably see equities rip and gold sell off. And also just the fact that you blast off through 3,000, went straight to 3,500, didn't even really blink. It's just when you see moves like that, it's really hard to imagine that commodity, especially in commodity world and in gold in particular. It was really I just would have been shocked if you'd not come down and tested 3,000. So it appears like maybe you've started that. So same thing on the gold side. If you've missed out on the run, there's some great names today. They got hit for like 9-10%. I don't think this runs anywhere close to over. I know that there's a bunch of mining stocks out there, especially ones that are a little further down the quality chain, that really didn't rally much at all with this latest run up. right? I will continue to say, if you think you missed the run in gold, you didn't, because it really didn't materialize. Or the gold went up, but on the gold mining stock side, it didn't really materialize. And like I said, it can move all over the place. It can do whatever it wants. But bottom line is, if you look at the backdrop, the impetus, the main drivers of it, central bank buying, safety haven buying out of China, India, places like that. When you look at it from those other foreigners' perspectives, I don't think the impetus to own more gold or buy more gold has gone down at all. Central banks, I would say the same thing. So, but again, I would be choosy, because I would be, like I said, I'd be shocked if gold didn't press down and test 3,000. And maybe even go back and test 2,500. I mean, it's not uncommon to see 25, 30% pullbacks. I think it's like 25% is kind of a normal retracement for gold. So you'd be 25. So, I mean, 3,500, 25 retracement would get you back down to, God, horrible night of sleep last night. So my math brain is not as sharp as it once was, or would normally be in this, but I think I get you down to like about 2,800, something like that would be a 25% retracement. So you see 30, 35, 7. Yeah. Right around 2,800. So, I don't think that I know for a fact the equities aren't expensive here. So, I mean, you could start building here. My whole point is you haven't missed anything. Let's see. Oh, another one, and this goes to a point we've been making a lot. And it played out again today. Let me check it. I actually didn't see the closing tick on this one. Okay. But what is everybody going to do? Everybody's going to rush into the queues, right? On an announcement like this. Today, the queues, well, let's see. I better say this because Tesla was up a lot. Let's see here. Yeah, so the queues were up 4, okay? On the same day, Chinese tech, so kind of the Chinese market's version of tech, was up 5.58, and then another 35 bips in the aftermarket. So solid outperformance, okay? This is the other thing that I think a lot of investors are forgetting. If you want to play the run, and if you guys all think this is super constructive, which it is, again, I'm not telling you to get out of your good, solid U.S. names that have good value. We still own some of them. I think we've got what did I say? Like 18, 20% U.S. exposure. We've got more U.S. exposure, but I mean, S&P 500, triple Q type, regular, index type exposure. But the muscle memory is going to push you back to the U.S. tech names. And I just don't again, if we're going to buy things that we know are trading outside of rational valuations, right? Are there more risks to owning Chinese stocks than there are U.S.? Absolutely. Okay, so if you hear me saying this, at no point am I advocating you go in there heavy on Chinese stocks or any of that kind of stuff. But I'm saying I do think that they could be part of a diversified portfolio. And in this particular time, if you've got trading chops, once again, everybody, right, the muscle memory move is going to be to pile back into the queues. But that's a momentum trade. And I think that you're going to get the same trade with more amplitude and far cheaper prices and stocks way further off their lows, off their highs in Chinese market, with still that fiscal stimulus coming down the pipeline and currently being doled out. So I think that this muscle memory play isn't I just think there's a lot more attractive things out there. Again, you're not going to hear us sit there and say we think the market's about ready to crash. It's going to be, yes, there could always be a crash. I just look at the markets right now. So many of these market names, and you got there. This is the other issue that worries me about U.S. markets. I think you've got multiple companies. Several might be too strong a word, but at the top of the index, like an Apple and Tesla, where the underlying stories were not good. And so the market is trading these things as if this was the only threat they were up against, and now we're back to just killing it. These companies were struggling before that. And so that's That's what concerns me. And then you look at the valuations and they're on the extreme end, especially for those names. And they have so much weight in US markets that without those names moving, it's really hard to see substantial upside on the index. So I kind of think the long case here for like an Apple at this valuation is you got to think they have some innovation up their sleeve that they're going to just, it's going to start ramping their growth again. I looking at Apple, I mean, honestly, if they post more earnings at all this year, if by the end of the year, they've got better earnings than they had last year, even if it's by a penny, I think that's going to be phenomenal because they're up against it and they're at the extraordinarily high range of their valuation. So that's again, not the risk, that cataclysmic market risk. You're just sitting there going, boy, it's just a hard ask for names that big. Tesla, the same thing. The reason that Tesla's sales are going down, I mean, some of the political stuff hasn't helped, but they're getting smoked by these Chinese companies. That's not going away. Well, yeah, but full self-driving, Waymo, you know what? So you make that, right? You start looking at these underlying now, and then think about it too. Think about if the whole DeepSeek impact on NVIDIA and everything like that, you know, that they've got an earnings miss. Again, I wouldn't guess that there's like a 40 or 50% drop ahead for NVIDIA, but could there be? Of course. But do I think it's going to be hard for NVIDIA to repeat what it did last year? Yeah. And let's say the news, you know, let's say the economy is a little worse. Let's say CapEx is a little bit lighter at some of these. Anyway, if you've got Tesla and NVIDIA and Apple struggling to get off the ground, you know, right there, what is that? You're looking at 11. That's almost, what would that be? 14, 15% of the S&P? So again, and like I said, is there room for multiple expansion? Gosh, I don't think so. Looking at those names, I don't see any reason for it. And everybody's like, well, with Tesla, full self-driving. Look, Tesla's going to need full self-driving to make up for the loss of market share. And I don't think that market share is coming back. Not unless they launch some really good. Right now, if you want a commuter car, right? If you want an EV and you don't want to break the bank and you want to get the most bang for your buck, I hope you buy Tesla because it's American made. Okay, but the Chinese companies are killing it. Better range, better looking interiors, way cheaper price. It wasn't tariff talk that was killing it. It wasn't even Doge stuff. Now, did that help? No. This is a competition story. And so then I look around at so many of these other markets and they've got the inverse issue. They don't have any of those issues. So I just continue to think that, again, you should always own U.S. stocks. And I think that I think the U.S. stocks should always be your biggest allocation to any country, right? We have the best system. We have the best form of government, the best judicial system. We do. And we're still home to the world's reserve currency. But I just think you need to diversify, right? We need to have other international, right? The U.S. only portfolio has worked for a really long time. I just don't think that's going to be the case going forward. So anyway, we've got to keep an eye on this. So I would say overall, economically, I think it's great. B, on the market side, hold on to the winners. We don't just sell the U.S. because it's less attractive. But you guys, I continue to, pound the table on the fact, be diversified. Take the opportunity to get that diversification and some things that might be getting hit, whether that's on the gold or metals side, whether the natural resources side. Diversification exists for a reason. And I think it is paramount in these times. But I think it is very fair to say that there is reason to be optimistic on the trade and economic side, because if there is positive traction on the trade side, it really starts to take the worst case scenario for the market and the economy off the table. So anyway, we got to roll. I will be back tomorrow again with Chase. We will see you then. Have a wonderful evening. You're listening to Know Your Risk podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.